All right. I am actually caught up, and yes, I am doing well. I am caught up with the chat. And so let's go into the next thing. So we just talked about China extensively and is it socialist and yeah, not so much. But let's talk about the United States, which definitely isn't socialist. I think it's fair to say. So I was writing something because a lot of what my attention is devoted to these days is watching the I think imminent downturn and probably return to a 2008 type scenario developing, because I think as that unfolds, it is going to have major, major consequences for the US working class deciding, oh, we need to think about politics again. And as it says in the fascism chapter that I was just reading, What is Fascism? It is when the crisis happens, the middle class, as the professions are thrown into unemployment, they all decide, oh, we need immediate relief and this and that. But politically, they don't really know which end is up. And they start falling into the arms of like whatever demagogue comes along and, promises that they're going to fix it, whether or not they make any sense at all. So, anyway, this is a community post that I put up, and it was actually off of a Game of Trades video, one of the finance channels that I've taken to watching recently. Not that I agree with their politics, but I like the analysis of what's going on. Just presenting all the charts, because I don't have a background in finance in that I don't know all the places to go for digging up the charts and the tables and all of that kind of stuff. So I do like to leave that to others to kind of present that and then kind of go over the, what does this imply? What are the consequences, etc. So anyway, they had a video that I was kind of summarizing here and extrapolating from. Prolonged yield curve inversion strongly suggests major economic crash on the way. And I wrote this about a month ago. So in finance, an inverted yield curve is when interest rates on short-term debt instruments rise above the interest rates of longer-term debt instruments of similar credit worthiness. In other words, this is an unusual situation in which, all else being equal, shorter term investments return more money than longer term investments. So, kind of the typical one to look at here when they're talking about an inverted yield curve is 2-year treasuries versus 10-year. When the 2 years are making you more money, something is up. Historically, inverted yield curves on US treasuries have been reliable indicators of impending recessions or economic downturns. And more prolonged inversions, like it goes on for months and months and months and years, generally correlate with more severe crashes when the crash eventually comes, as the video that I had linked to demonstrates. And then, of course, if you watch it the last 30 seconds, I kind of like their channel for the charts that they do. They put in really obnoxious ads for their trading advice services. But anyway, so our current situation in 2024 is that the yield curve has been inverted, 2-year higher than the 10-year, for 540 days. That is, I think, the third highest ever. It's comparable to the durations of the inversions preceding the 1974 crash and the 2008 global financial meltdown. Both of them were in the low 500s. And it's second only, oh, so yeah, it's right up there. Second only to the 1929 market crash that kicked off the Great Depression. That had been inverted for 700 days when it finally crashed. So we're second only to the Great Depression right now in terms of the duration of the inversion of the yield curve. The stock market is currently still going up, but keep in mind that the stock market went up for a long time after the 2008 era inversion as well. Actually, so after the yield curve inverted prior to 2008, like in the lead up to 2008, the stock market kept going up for almost 2 full years. It went up for 657 days, and that was a record. So if the market now were to keep rallying for that length of time today, then the crash would begin this August. So if you counted 675 or 657 days from when our current yield curve inverted, that would be August. So let's put it this way. If the stock market doesn't start to crash before August, it will be a new record, which is possible, but unlikely. So sometime in the second half of this year, either late second quarter or third quarter or fourth quarter, we're likely to see this. And if it keeps going, that would be really something very impressive. But actually, as far as the stock market continuing to rally after the yield inversion curve flips, the Great Depression was crazy in this regard. The stock market almost doubled in value, like at this between that and that. So there was just this insane enthusiasm and optimism, and then actually it just crashed and lost like a super significant portion of its value. And this is the way that investments work, and it takes the economy down with it. So massive, massive crash. So what are the implications? Well, 2008 showed us in recent history that the average person will be angry and more ready to question capitalism itself when events like this happen. As Marxists, we must prepare to do widespread agitation, education, and organizing in its wake, spreading real knowledge about how to understand, resist, and fight back against capital. I linked an Investopedia article with more about the inverted yield curve. Somebody was asking, like, why? So basically, when the yield curve is inverted, it signals that there is a lack of confidence among investors in the future of the economy. Okay, so the longer that this goes on, it kind of corrodes. And then when there is a financial stressor, so it can be, as recently happened in 2020, a pandemic. That's kind of rare. More commonly, it can either be a stock market crash or an oil or other commodity price shock, but especially oil because everything is tied to oil. It's like really, really fundamental. And so like if we hit a stock market crash now and the stock market does seem to be massively overvalued, that with the inverted yield curve, it means that the inverted yield curve is like corroding the base. So when that shock comes, the base crumbles, basically. And the longer that it's corroded for, the longer that the yield curve is inverted for, it is correlated with worse and worse extensive crash. Like the crash has a more negative impact. And so if you're interested in that, just go to the community tab on the S4A YouTube, scroll down to 4 weeks ago, and you can see that Game of Trades video. So coming off of this, we're in a very precarious situation. Like, you know, to be on the 2008 level, the stock market would crash somewhere around August. So we can expect that it'll crash like June, July, August, September. If it went much further than that, it'd be really like new record territory. But probably sometime between now and the end of the year, that is going to begin. So let's start getting ready for it and understanding, first of all, where all this is coming from and what's happening and like what is going on in this environment. So basically how they got out of 2008 and have kept things, you know, somewhat copacetic since then. There was actually almost a crack up in late 2009. Had nothing to do with the pandemic, had to do with the repo market. There was almost a big problem. Basically, they put all this stuff on the Fed's balance sheet and then they can't seem to get rid of it. Every time that they get like 7 or 8% rid of it, there's like another major event threatening to occur. So where I was coming from in pulling the next article, which I'll put up on the screen now, is they're using this new technique of just doing lots and lots of stuff on the Federal Reserve's balance sheet. And before we even get into this, let's look at a nicely colorful graph of the Federal Reserve's liabilities. So here's a table, evolution of the Fed's liabilities, or a chart rather. So you can see that currency is the green line. It's fairly steady, has gone up definitely somewhat in the last few decades. Then the blue is reserves. This is brand new. They didn't really do this before the 2008 crisis, or like in very, very small amounts, not at all comparable to what's going on now. Then there's the reverse repo market or reverse repurchase market. That is orange, and then other liabilities in red, being maybe the smallest, but at times fairly significant. So you can see they're juggling a whole bunch of stuff that they never used to do in the past. And it's kind of reaching a crescendo, especially in the pandemic era. Like, it shoots up dramatically then. This is how they've been keeping another 2008 at bay. But can it last forever? Can they just keep stuff on their balance sheet without any consequences. Well, that's what the article we're about to read has to do with. So, this is from the Chicago Booth Review, and the title is Rate Hikes Are Costing the Fed and the Treasury, and Stubborn Inflation Could Make Things a Lot Worse. This is by John H. Cochran, February 2 of last year. So, let's just read it. In a period of elevated inflation, which is high prices, such as we're currently experiencing, the interaction between fiscal and monetary policies can lead to some curious phenomena. See, for instance, the chart below, which shows that between September and mid-January, the U.S. Federal Reserve lost more than $20 billion. And you see a chart there, Federal Reserve earnings remittances owed to the Treasury, and you can see that that went way, way negative. What's going on here? What does this line represent, and why is it crashing through the floor in the past 6 months? This chart visualizes an interesting process starting to get underway and hints at how higher interest rates, which the Fed is using to fight inflation, could end up being a big fiscal issue. Here's the story. The Treasury pays the Fed interest on the Fed's asset holdings of Treasury securities. The Fed pays interest on reserves to banks and to other financial institutions that have effectively made deposits at the Fed. As long as the Treasury interest the Fed receives is greater than the interest the Fed pays, the Fed makes money. It spends some and returns the balance to the Treasury. The Fed also issues cash, which pays no interest, so the Fed makes steady money on the difference between interest-bearing assets and the zero return of cash. But when the short-term rates the Fed pays rise sufficiently to make its interest expenses greater than its interest earnings, the Fed loses money. It stops sending interest earnings to the Treasury. The chart is in essence the amount the Fed has lost. Usually the Fed makes some money. The chart line goes up. Then the Fed pays out to the Treasury and the line goes back to near zero. When the Fed loses money, the Treasury doesn't send a check to bail the Fed out. Instead, the Fed accumulates its losses, $20 billion so far. The Fed then will wait to make this amount back again before it starts sending money to the Treasury. For broad brush macroeconomics, the Fed and the Treasury are the left and right pockets of the federal government, so this fact has no direct implications. What it means is simply that as interest rates rise, the government is going to pay more interest on its debt, which includes the Fed's liability of reserves and cash. The event is revealing, however. The Fed's massive quantitative easing operation has undone a lot of the Treasury's long-term debt, which would have kept interest costs from rising so fast. The Treasury issued long-term debt, the Fed bought it and issued short-term debt instead, and they will share profits and losses. So the Fed's losses are really just a measure of the extra interest on the debt that QE has caused. Granted, $20 billion isn't a huge amount in today's Washington, but the process suggested by the chart is just getting started. Implications for the Fed. No, the Fed is not about to go bankrupt. The Fed can print money, so conventional bankruptcy, which is when you can't pay bills, simply cannot happen. If they have a bill, they will print more money, but that printing money can have consequences. If the Fed had no assets at all, it could simply print money, create new reserves, to pay the interest on outstanding reserves. That would only come to an end if the Fed had to soak up reserves or cash by selling assets to avoid inflation, which is really the consequence. Also, the accounting involved is a little weird. The Fed only counts interest income and ignores mark-to-market values when calculating its remittances to the Treasury. So we're talking about the accumulated interest received on the Fed's assets minus interest paid on reserves. The Fed has taken a bath in mark-to-market asset values as interest rates have risen. The Fed doesn't need to worry about it because it can hold the securities to maturity. However, this means that the Fed will likely have to hold them to maturity. The Fed now has $8.5 trillion of assets. A speedy quantitative tightening, selling those assets, would force the Fed to recognize mark-to-market losses. So don't count on that event. Fortunately, in my view of the world, QE didn't do much but shorten the maturity structure of outstanding debt. So the lack of QT won't be missed. Others disagree. Alyssa Anderson, Philippa Marks, Dave Na, Bernd Schlusser, and Zeynep Senyuz at the Fed have a very nice analysis of the situation, along with explanations of how it all works. In their baseline projection, the federal funds rate jumps from near zero, where it was in early 2020, to a median of just under 4% for 2023, below where it stood as of mid-January of this year, before gradually declining to stabilize around 2.5%. Well, anybody in the chat, where are we now with the federal funds rate? Has it gradually started to decline to stabilize around 2.5%? So when is that going to happen? Under that projection, the Fed's interest income dips between 2022 and 2025, even though interest rates rise. The Fed is still sitting on old bonds with very low interest rates. Interest income starts rising when these mature, and the Fed reinvests in new bonds with higher interest rates. Interest expense, on the other hand, responds much more quickly to the rise in rates as the Fed pays higher interest on reserves, but the projection largely follows the reasonably rosy scenario that the funds rate eases as inflation goes away. Well, it definitely has not done that yet, I want to point out. And again, this article was written over a year ago. The rate hikes that they've done have not really had that effect. And so they're now talking about higher for longer again, because they're talking about, I mean, they really never stopped talking about higher for longer as far as the federal funds rate. But the market really started getting nervous about that and was like, but you're going to cut them soon, right? You're going to cut them soon, right? And they're like, we might if things change. And then everybody's like, they're going to cut them. Like, well, no, we're always going to do that if things got better, but we need to keep them high to try to tame inflation to the arbitrary level of 2% per year, where prices keep rising. No, you actually need prices to come down from where they are now because they're in an insane bubble right now. Nobody can afford anything, but they're still talking about they haven't tamed it to the 2% level even, and that's with holding the rate high. So nothing's really going to plan so far. But anyway, the bottom line in their projection is that remittances to the Treasury stop for a few years while interest expense is greater than earnings, but then pick up again once the Fed can roll over its asset portfolio. All well and good, but I can think of plenty of ways this can go wrong. Suppose inflation does not fade away, as is happening so far, and substantial interest rate hikes are needed, as seems to be the case. Suppose, for example, we replay 1980, when short-term interest rates shot up to nearly 20%, except this time with the Fed maintaining a huge balance sheet and paying interest on reserves. So those interest rates matter in terms of, again, let's go back quickly to the chart. Now, in 1980, the line was even lower than it was in 2004. I mean, it was like fairly steady, but it was about at that level. So that's what they had to worry about at that point. Very, very small level of reserves. Now they got the weight of the world, or the weight of the world economy on their back here. And if they have to start paying 10, 15% interest on that, yeah, that's not a situation that really can hold for very long. I mean, are you risking hyperinflation at that point or what, as they have to just keep, because again, they can print money, so they're not going to just default on things. They're not going to just not pay the bills. But how much money do they have to start printing at that point? We're going to look at the U.S. national debt in general in a minute. So second to last section here, the cost of high interest rates for taxpayers. If short-term rates reach the level of the 1980s, this is what they were just talking about, the Fed's interest expense could rise to $1 trillion. High yields on government bonds would also be costly for the Treasury. Because remember, the government partly funds itself by selling bonds that they then pay interest to investors on. And the more that they have to pay, the way that you entice people into buying your bonds is by offering an attractive interest rate, an attractive return on that investment. And that's expensive for the government. So, how else does the government raise money? Well, through taxes. But, and so, we're just coming through tax season now. They just collected money. You're unlikely to see a major crisis at this point. But, as their bond auctions may not hit all the targets, it's like getting into really shaky territory. And again, you have on the consumer, like average worker or proletarian level, people are racking up record amounts of debt just trying to pay their bills and get by and get food and pay for rent and mortgage and all that kind of stuff. We've talked a lot about housing. We haven't really talked about the car market yet. The car market is doing the same thing that housing is. Now, you can get by a little easier without a car or access to a car at least than with housing. It's less essential. But in U.S. society, it's still pretty necessary in many places to have a car, at least be sharing a car or something like that. And prices, again, just with housing, are insanely high and need to start coming down. I think that you're going to start to see eventually, as the crash hits, a sale 20% off, 25% off, 30% off, maybe even more. And then eventually those quote sale prices will probably just become like the regular price because, that's how much things are inflated right now and so on. So it'll be like 30% off. And it's like, well, it should never have been that high in the first place. So you're kind of just coming back down to maybe where it ought to be. But anyway, that crash, it's so precarious. But anyway, let's finish. The Fed's $8.5 trillion in assets corresponds to about $6.2 trillion of interest-paying liabilities, including $3 trillion of reserves and $2.5 trillion in reverse repos, which are essentially reserves for non-bank financial institutions, plus $2.3 trillion of currency. Even assuming that people still will hold that much currency as interest rate spikes, which they won't do and didn't do in 1980, $6.2 trillion times 15% equals nearly $1 trillion of interest expense. Now we are talking real money. The Fed's maturity shortening via QE will cause the government an extra $1 trillion of deficit per year. And this is what I'm saying. This is how they got out of the 2008 scenario. There was a credit crunch. Nobody wanted to lend to anybody. Liquidity totally dried up. It was like a car engine without oil, just seizure. So that's where the Fed was like, and so the Fed chairman, Ben Bernanke, got the nickname Helicopter Ben because he was like, push comes to shove, we drop money from helicopters just to get the economy going again. And that's basically what they did with QE. They dropped the interest rates to 1%, then to 0, and people still, the lenders still didn't want to lend because nobody seemed creditworthy, and there was this overall crisis of confidence. And so QE comes in. They're like, all right, look, we'll manage it, just get the economy going again. But now continuing this is costing them as interest rates go back up. Like, remember, this has been a very low interest rate environment for a very long time. Now the inflation is like out of control. They're raising the rates in an effort to get that down, but that's having consequences for how much they have to pay. So, and this is the tip of the iceberg. The Treasury will also have to refinance all the debt that the Fed is not holding at the same higher interest rates. The Treasury debt isn't that long-term either. The federal government is a lot like a couple that bought a mega mansion they can't really afford and took out an adjustable rate mortgage on. If rates stay high for very long, this will start to get very expensive indeed. So do you get into a hyperinflation scenario where we already have a problem with just high inflation, but not catastrophically high quite yet? I feel like we're on the cusp of things are really, really becoming unaffordable, but it's not yet at the point where, a loaf of bread costs a wheelbarrow full of currency, etc. So talking about all this, and then I want to talk about the corporate debt wall that is looming. This is from the Treasury, fiscaldata.treasury.gov, I think is the thing. So this is the U.S. national debt over the last 100 years. So what they are trying to do here to keep things funded is, well, the level of debt is just going up and up. This might not be the worst problem, except that to finance this, they're having to sell more bonds and do other things, which is escalating in the way that the article just said. So as far as the average worker is not an investor, but is this going to cause a major calamity in the system? Because remember, when the recession hits, finally, one of the major components is mass unemployment. In the 2008 crisis, I think unemployment got up above 10%. And, in the past, in the Great Depression, much higher than that. So what are we looking at? You already see people, the average working person is taking out more and more, actually collectively a record amount of credit card debt, just to get by. There's also huge numbers of charge-offs surging where the credit card companies are just writing off debt as not really collectible. And this is before the layoffs even have started. So very concerning signs. And again, we've got the inverted yield curve. All you need is a major shock to this economy, a stock market crash, an oil shock. Oil shock could come from if the war that Israel's doing with the genocide in Palestine expands to a regional war, which the U.S. is trying to prevent by parking warships off the coast so that Israel and around the world so that Israel can keep doing what it's doing. They're trying to prevent it, but it may or may not actually work. So there could be an oil shock, there could be some other thing, or it could be some other less common scenario. But in other words, bottom line, you've got such a shaky situation here. And again, going back to the tricks that the Federal Reserve has been using to, manage this thing away, it might become prohibitively expensive. They were able to do all this when interest rates were very low. But again, like they said, if it goes to 10, 20% as it has done in the past, that may not really come without other structural consequences. So, but this is kind of the government side and the management of the overall capitalist situation. Let's talk about some of the companies, because corporations also are not immune to the situation. As we've talked about before, there's a lot of debt out there that is about to be refinanced this year and especially next year at possibly much higher interest rates. A lot of companies probably aren't going to be able to do that. They will close or shrink. People will be laid off. That's probably how the layoffs will start, or at least one portion of it. And again, if it happens in a key sector, that can drag down the whole economy and so on. Here's an article that's more on the optimistic side. This is from 2 months ago, March 4, published in Reuters. And it deals with this topic. They're trying to give it a positive spin. I think that it may actually not be that positive a situation, but the title of the article is U.S. Junk Bond Maturity Wall Not as High as Feared by Jamie McGeever. Thought I was reading that wrong. Anyway, let's read. So, Dateline, Orlando, Florida. What looked from a distance like an unscalable debt maturity wall for junk-rated U.S. companies next year might be easier to jump after all. So basically the corporate debt wall is these companies have debt that they need to, refinance, like it expires, and suddenly they're not going to be able to do things at 0% interest or 1% interest. As the saying goes, anything is a sustainable business model at 1%. But if you have to do it and be profitable as capitalism demands at 5%, 6%, 7%, 10% if it goes that high, there's a lot of companies that are not going to be able to scale that, and bang, that is where the contraction, that's where the rubber meets the road. So with borrowing costs elevated by the Fed's most aggressive interest rate hiking cycle in 40 years, which are expected to stay high, there are fears that firms with the lowest credit ratings will struggle to refinance, potentially spreading a wave of defaults and financial distress over the wider economy. Some of the numbers are certainly eye-catching. Nearly $1.5 trillion of high-yield debt, including loans, is maturing globally through the end of 2026, of which $882 billion is U.S. debt, according to S&P Global. So that's more than half is from the U.S. There's also significant amounts in the EU. They're facing a gigantic debt wall. Of that, $338 billion is in bonds. $53.8 billion is maturing this year, $125.5 billion next year, and $158.6 billion in 2026. These are large amounts of debt for companies having to refinance at potentially double the original rates on the loans. But early indications show that they're managing to do just that. Well, we've barely started, so don't count your chickens before they've hatched. And there are reasons to believe that they can I want to believe, that they can successfully navigate the path ahead too. Everything's fine. These people, they will tell you everything's fine, like literally as like everything is collapsing to the ground. And then they're like, oh, I guess we had some outdated information. Anyway, the economy is showing no sign of rolling over. Attractive yields are bringing lenders back, while cooling inflation keeps rate cuts on the table. Not really. Actually, the inflation is not cooling enough, and the Fed has been more clear that it seems to them less likely that they're going to be cutting anytime soon. So, this is like the level of just wishful thinking and believing what you want to believe that is so prevalent in the sort of mainstream articles on a lot of these topics. It's a favorite, and why? Because they need the money to keep flowing. It's a con game. They need your confidence. They need your belief. Like there are reasons to believe. Yes, hand over that money. Everything's going to be. Oops, did you lose everything? It's a favorable set of conditions for junk-rated firms, which tend to begin rolling over their debt earlier than cash-rich investment-grade firms, around 12 months before maturity. S&P Global Research shows non-financial firms globally last year reduced 2024 maturities by 44%, lowered 2025 maturities by 27%, and even started trimming 2026 maturities by 6%. Looking solely at corporate bonds, excluding loans, the 2024 maturity wall was reduced by 13% last year, and the 2025 wall was lowered by 6%. This has continued in the first 2 months of the year. Quote, in our view, the maturity wall is not a significant risk over the next 12 months, said Amanda Lynham, head of macro credit research at BlackRock. So there you have some visual representation of the corporate debt wall. And you can see for each of the years, there are 3 bars. So one of them is as of 2024. And then, so it's basically every 6 months. The blue one is January 23. The orange one is July 23. And then January 24 is that maroon or purple or whatever it is one. And so it has gone down. They've been able to pay some of this off. But let's read on. I can CCC for miles. Lynham also notes 2 other encouraging signals for the high yield market. Default rates may be plateauing, and there is an increased willingness to lend to the lowest quality borrowers. So that is the opposite of a credit crunch where nobody can get funding. But this is right now under pretty good conditions. So I wonder how many of those assumptions went into this. But continuing, default rates on junk-related corporate bonds, those with a BB minus credit rating or lower, double B minus credit rating or lower, look to have leveled off in recent months around 4%. That in itself is a pretty low level historically, certainly relative to previous episodes of wider economic or financial stress when they reached 8% at a maximum. Default rates may well rise further, but not that far, barring an unforeseen shock. Well, what were you just talking about? Analysts at S&P Global expect the U.S. trailing 12-month junk corporate default rate to reach 4.75% by the end of this year. After a near uninterrupted 2-year hiatus since the Federal Reserve began its policy tightening cycle in March 2022, CCC rated U.S. borrowers are issuing debt again. They feel confident coming back to the market, but lenders are also prepared to lend to them again. The resilience of the junk bond market, yield spreads over treasuries, are the narrowest in 2 years, indicating that the economy's glide path to a, quote, soft landing or even no landing has perhaps been hiding in plain sight all along. So this is what this article is about selling you on soft landing, no landing yet again. While the deeply inverted yield curve, which literally signifies a recession every single time, soured consumer confidence, and consumers just holding on by their fingernails, and other time-honored recession markers have long flagged a pending downturn, the high-yield bond market has been flashing completely opposite signals. Junk bonds are often among the first assets investors dump when rising interest rates start to bare their teeth. Credit conditions become too tight, and the good times on Wall Street and Main Street come to a halt, sometimes a crashing halt. Yeah, except what? Wall Street is still continuing to rise on the AI hype and on other just general confidence. And people really think that this time is different and capitalism has worked out all the contradictions and there's never going to be a crash and soft landing, no landing, et cetera, et cetera. So, they act like this is some brand new magic trick every single time that it happens. And that's what you're seeing in this article again. Anyway, here's a some note of critical thinking. But if higher for longer borrowing costs are a headwind for junk, stronger for longer economic growth is an even more powerful tailwind. So, in other words, even if that happens, don't worry because general economic growth is going to be fine. Quote, we view a stronger economy as more favorable for credit quality as it should help to support issuers' revenue and growth, which can help to offset higher borrowing costs, said Evan Gunter, Director, Credit Research and Insights at S&P Global Ratings. And the conclusion, tougher test in 2028. Yeah, I don't think it's going to hold together that long. Junk-rated companies don't have the cash buffers to see them through the bad times that investment-grade companies do. So they are more reliant on good old-fashioned growth to ensure that they can meet their borrowing needs. To be sure, these needs will become more pressing in a few years' time when post-pandemic borrowing starts to mature. And of course, the pandemic's still ongoing. They just mean the time when people treated the pandemic as real. According to S&P Global, the global high-yield maturity wall in 2028 will be $1 trillion, higher than the investment-grade wall. That may scare the horses, but there's a long way to go before then. So the whole article is a tone of very obvious persuasion and attempting to reassure. As Michael C. Eisenband, global co-leader of corporate finance and restructuring at FTI Consulting, points out, every bout of maturity wall panic in markets or the media in the past 15 years has passed off without incident. Okay, yes, because the Fed has been doing incredible new feats of juggling to stave it off. The argument here is that time has finally come and all the things that they have done to forestall the inevitable are finally coming home to roost. Super loose Fed policy and trillions of dollars of quantitative easing might have helped, of course, but he has a point. Quote, much like other feared apparitions such as the Loch Ness Monster and Sasquatch, that's how real this is. The maturity wall is visible at great distance, but never up close, he wrote last month. Well, recall a few streams ago when we covered before every crash, including '08, there was still the chorus of soft landing, no landing, etc. Even the guy that coined that term was dramatically wrong. This was like late 70s, I think. So this is what we've got. It's like, oh yeah, maybe 4 years from now, you might have to worry about it a little bit, but for now, everything's fine and it's going to continue to be fine. And honestly, this makes me more concerned than anything else. One last thing on this topic. This is from another article from Bankrate. This is talking about quantitative easing and how the Fed is trying to back off of that a little bit. Because, again, as we're looking at the chart, quantitative easing is when this line goes up with the blue and the red and all that stuff. They've done a hell of a lot of it. Every time that starts to go down, what happens? It starts going back up again and eventually to much higher levels. They can't get out of this. Okay? So that's why be concerned, because they're doing stuff now which is going to get expensive. And if they have to discontinue this because of the expense of this, yeah, they were able to do it for 10 years, even 15 years. But can they keep it up forever? Well, it's going to get expensive if the interest rates stay high. And when they dump this, what is going to happen? You might see something that dwarfs 1929. If the length of the inverted yield curve is any indicator, and there are other indicators. We talked about the Buffett indicator, and which is just GDP to the stock market. The stock market's hugely overvalued. Speaking of Buffett, there's a number of stories right now on how Buffett's investing firm is widely viewed as kind of like the smartest or just most successful investor ever. They're sitting on a massive record pile of cash. They're not investing in anything, which suggests that they don't see the economy being very strong and probably that there is going to be a crash when prices are going to become much more favorable for them to buy up a lot of new stuff and, consolidate capital even more. So just all the writings on the wall that this is like the eerie calm before the storm, and articles like the one we just read, again, just a bit chilling. But anyway, going back to this Bankrate thing, talking about quantitative easing, just because the Fed is slowing down the process now and doing a little bit of tightening again, also doesn't mean that the balance sheet will stop shrinking. Much like a car that slows down as it approaches its exit on the interstate, officials will instead just try to approach their destination much more gradually. Quote, normalizing the balance sheet, which is what this whole article was about, is like, where does quantitative easing end? They doesn't seem like they can ever really successfully pull off quantitative tightening or get it back down to a level. And the article was basically like, well, they probably will never go back to pre-pandemic or let alone pre-2008 levels. So, just get used to this sort of massive amount on the Fed's balance sheet. But can they sustain that? Anyway, quote, normalizing the balance sheet more slowly can actually help to get to a more efficient balance sheet in the long run by smoothing redistribution and reducing the likelihood that we'd have to stop prematurely, which is what they've had to do every time, said Dallas Fed President Lori Logan, who was at the helm of the last nomination process while working at the New York Fed during a January speech. But I mean, like, why have they had to stop prematurely? They had to stop in 2019 because of Repo Madness and the threat of a credit crunch. And they had to stop in 2023 because of the failures of SVB and Signature. So that's what happens as they tighten, is especially right now, the small and medium banks start to pop. Anyway, but no matter what, consumers are unlikely to ever see the Fed's balance sheet or banks' reserves return to the levels they were in the past. Quote, it's Hotel California. You can check in but never check out, McBride says. When you focus on downsizing it, you only downsize it a little bit, and the next crisis, it gets bigger and bigger. The next 50% change in the size of the Fed's balance sheet is going to be larger, not smaller, unquote, end of article. So there you go. It's still hasn't hit yet entirely. The unemployment hasn't spiked yet, and when it does go up, it tends to go up very sharply. But that hasn't spiked yet, and everything for now has not totally fallen apart. People are still getting by on credit, and major waves of businesses haven't gone under. But how long can they keep this up for due to those rising costs and a higher interest rate environment?